Good afternoon, everybody. Welcome to Liberty Call for Wednesday, May 25th, 2022. Hope everybody's having a pretty good day out there. I mean, there's a lot of bad news in the news, and hopefully that's not getting us down too much. I try to stick to the financial stuff. No one really cares about my opinions about other things going on in the world, so we'll stick to money right now. So, if it's your first time watching, give me a thumbs up, a share, a like, all that good stuff. Certainly would appreciate it. It makes my life a lot easier, and I'm sure there's a lot of people out there who could use some help navigating all the madness going on right now. So, glasses are a little off center. All right, well, let's go ahead and jump into today's markets and take a peek and see how they turned out. All right. Dow Jones was up zero point 0.6, closed at 32,120. SP 500 was up 0.95, closed at 3978. NASDAQ up 1.51. Good to see the tech sector bounce back. But again, I wouldn't get too excited about it because, it's going to be a long haul down to the bottom of the trough. Small caps are also up 2%. The VIX receded today 3.67%. It's currently sitting at 2837. Moving over to the other exchanges here in the Americas, Canada was up 0.48. Brazil looks like it was flat. Mexico up 0.9. Moving over to Western Europe, Germany up 0.63. The UK up 0.51. France up 0.73. The Euro Stoxx was up 0.81. Netherlands was up 0.62. Spain up 1.5. Italy up 1.57, Switzerland flat at up 0.07, Portugal up 0.88. Who's this? Belgium up 0.5%, and Austria up 1.88. All right, let's look at the Russian markets. They were split again. The MOEX was up 2.03. The RTSI was down 2.72. Moving on down to the Asian markets, Japan was down 0.26, Australia up 0.37, New Zealand down 0.92. Looks like the Chinese markets were all in the green today. The Shanghai was up 1.19, the SESE component up 0.7, China A50 up 0.35, the DJ Shanghai up 1.12, and the Hang Seng up 0.29, and the Taiwan weighted came in at up 0.88. So all in all, looks like the Asian markets were fairly good. I mean, a few reds here or there, mostly green across Europe, which again, a positive sign for the day. And we're here in the green here in the United States. And let me bring up my chart. Here we go. You don't care about that. As I mentioned about the NASDAQ, again, this trend has been really going since the first of the year, and I really just don't see it breaking this yet. So, I mean, as of right now, it looks like the NASDAQ is down about 27% just year to date. And again, until that trend changes course, I would say we're probably going to see a lot more of the same. So, anyways, all right. Let's go ahead and jump into the day's market recap. S&P 500 edges higher as tech steadies, retailers rebound. S&P 500 climbed higher Wednesday after swinging between gains and losses as the Federal Reserve May meeting minutes showed the central bank was keen to move quick on rate hikes to allow breathing room on tightening later this year. Participants judged that it was important to move expeditiously to a more neutral monetary policy stance. The minute showed front-loading rate hikes would allow the central bank breathing later this year to consider a policy readjustment later this year. Quote, many participants judged the expediting the removal of policy accommodation would leave the committee well-positioned later this year to assess the effects of policy firming and the extent to which economic developments warranted policy adjustments. Boy, that's a word salad that basically just says they'll make a decision later in the year based upon the circumstances. Consumer discretionary stocks were the outperforming sector as Nordstrom's quarterly results helped improve sentiments on retailers. Nordstrom reported a wider than expected loss in the first quarter, but revenue jumped to pre-pandemic levels to top Wall Street expectations, sending its shares more than 12% higher. Uh, JWN has demographics and product category skew advantages at this point in the reopen, said Credit Suisse, but also flagged concerns about the uncertain economic backdrop of retailers in the second half of the year. Dick's Sporting Goods reported a softer outlook for the full year, but first quarter results beat on both the top and bottom lines. Its shares rose more than 8%. Urban Outfitters also reported record sales that overshadowed weaker than expected earnings and the impact of rising costs. Wall Street also pointed to strength in the retailer's uh, anthropology and free people movements brand. I'm not sure what that first one was. Quote, despite the miss, sales at Anthro and FP Movement continue to perform well due to demand for apparel, dresses, and fashion, said B. Riley said in a note, quote, we continue to believe that Urban has upside and Anthro is seeing a recovery as consumers look for fashion and occasion wear, end quote. Bath and Body Works, Under Armour, Ralph Lauren were among the biggest gainers, while a climb in Tesla also supported the sector. Housing stocks led by Toll Brothers were also in the ascendancy, shrugging off recent data pointing to a slowdown in the housing market. Toll Brothers reported better than expected quarterly results, buoyed by strong demand for housing, though the home builder highlighted the impact of rising mortgage rates and softer macroeconomic conditions. Lennar, Pulte, and Tri Point Homes were higher. Technology, meanwhile, cut some losses as big tech, including Apple and Alphabet, moved off session lows. Nvidia was up more than 4% ahead of its quarterly results due to after the market closes. In other news, Beyond Meat jumped more than 11% after the meatless company announced an endorsement deal with influencer Kim Kardashian. Wow, makes me want to go out and eat a fake burger. All right. I got three more articles I'm gonna blaze through pretty quickly, so let's jump right in. Fed keen to move expeditiously on hikes to allow reassess later. This comes from the Fed minutes. Federal Reserve policymakers agreed that the central bank should move expeditiously on rate hikes to rein in inflation, but also hinted that the Fed could be well positioned for a pause later this year. Why would they want to pause? Mhm. Do they think that the economy is going to crash and they're going to need to lower interest rates and do some more QE? I think that's what they're saying. Quote, participants judged that it was important to move expeditiously to a more neutral policy stance. In quote, the minute showed the need for speed on rate hikes would provide the Fed with much needed breathing room to potentially reassess the pace of tightening. The minute showed, quote, many participants judged the expediting the removal of policy accommodation. Oh, we already read that in the previous article. The minutes echoed recent commentary from some Fed members who have been floating the idea of a Fed rate hike pause later this year. Quote, I've got a baseline view where, for me, I think a pause in September might make sense, Bostic told reporters Monday following a speech at the Rotary Club of Atlanta. The data appear in support of a less hawkish Fed. Inflation expectations have been trending lower, and tightening financial conditions are beginning to hurt demand in key areas of the economy, including housing and manufacturing. The 10-year inflation break-even, a key measure of inflation expectations over the next decade, fell to 2.6% earlier this week, still above the Fed's 2% target, but down more than 3% seen in late February. At the conclusion of the previous meeting on May 4th, the FOMC raised its benchmark rate range to 0.75 to 1%. The move marked the biggest Fed rate hike since 2000. In the press conference that followed the monetary policy statement, Fed Chairman Jerome Powell signaled that further 50 basis point rate hikes would be needed to slow economic growth and rein in elevated inflation. Quote, there is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings, Powell said it at the press conference May 4th. The Fed chief also quelled fears that the central bank was eyeing a much larger rate hikes at upcoming meetings. 75 basis points is not something the committee is actively considering, Powell said. Treasury yields have responded in kind, giving up their recent gains, with 10-year Treasury yields retreating from 3%. A further tightening in financial conditions will get underway next month as the Fed kicks off quantitative tightening by trimming its nearly $9 trillion balance sheet. The Fed started reducing its balance sheet. The Fed will start reducing its balance sheet on June 1 at a pace of $47.5 billion per month. Under the plan, the Fed would initially cut would initially allow 30 billion in treasury securities and 17.5 billion in mortgage-backed securities to roll off his balance sheet, with the intent of gradually stepping up the pace after 3 months to 60 billion and 35 billion per month, respectively. So I read through the minutes on the Fed website. It's kind of like reading, kind of like the military manuals I had to deal with in the Navy. It's just the driest crap you could ever imagine. So, I tried to go through and highlight a bunch of sections, but it was just so boring. I figured I'd let someone else who actually read it also, who's better at putting stuff on paper than I am, to I'd rather read through their notes. All right. U.S. core capital goods orders growth slows in April. Shipments increase. New orders for U.S. capital goods increased less than expected in April, suggesting businesses could be slowing their pace of spending on equipment as they confront growing headwinds from rising interest rates and tightening financial conditions. The mixed report from the Commerce Department on Wednesday followed on the heels of May regional factory surveys last week, showing manufacturers expecting moderate growth in capital spending over the next 6 months. The Federal Reserve has adopted an aggressive monetary policy stance to cool demand and tame inflation, sparking a stock market sell-off and boosting U.S. Treasury yields and the dollar. Quote, rate-sensitive business equipment investment growth is beginning to slow, said Michael Pierce, a senior U.S. economist at Capital Economics in New York. Quote, this is consistent with our view that that economic activity is bending rather than breaking under the impact of higher rates, end quote. Orders for non-defense capital goods, excluding aircraft, a closely watched proxy for business spending plans, rose 0.3% last month. The so-called core capital goods orders advanced 1.1% in March. They were up 10% on a year-on-year basis. Economists polled by Reuters had forecast core capital goods gaining 0.5%. That the data are not adjusted for inflation, which also contributed to the gains in orders last month. Quote, when production inputs are more expensive, maintaining existing investment levels and replacing depreciating capital markets makes a business spend more dollars, even if the investment does not really expand capacity, said Will Cupernell, a senior economist at FHN Financial. Core capital goods orders were held back by modest decreases in bookings for fabricated metals, as well as electrical equipment, appliances, and components. There were solid increases in orders of machinery and primary metals, but orders for computers and electronics products barely rose. Shipments of core capital goods increased 0.8% last month after climbing 2% in March. Core capital goods shipments are used to calculate equipment spending in the gross domestic product measurement. Wall Street stocks were trading higher following recent sharp losses. The dollar rose against a basket of currencies, and the U.S. Treasury debt prices were mostly up. Clouds are looming. Robust business investment in equipment helped keep domestic demand strong in the first quarter as the economy contracted at a 1.4% annualized rate, burdened by a record trade deficit. April's increase in core capital goods shipments suggested business spending would keep growing, though probably not at the 15.3% pace logged last quarter. Despite the strong growth in shipments, clouds are looming over business spending and manufacturing. The Fed has raised its policy interest rate by 75 basis points since March. The U.S. Central Bank is expected to hike the overnight rate by 0.5 percentage point at each of its next meetings in June and July. Minutes of the Fed May 3rd and 4th meeting published on Wednesday showed a few participants indicated that some of their business contacts were reportedly hesitant to expand capacity or had postponed construction projects. Although overall business investment remained underpinned by strong consumer demand, healthy household balance sheets, and inventory rebuilding. A survey from the New York Fed last week showed a measure of capital expenditures by businesses in New York State fell in May to its lowest level in several months. The Philadelphia Fed's gauge of future capital expenditures dropped to its lowest reading since February of 2016, which the regional bank said suggested, quote, less widespread expectations for capital spending, end quote. China's zero COVID-19 policy, which led the shutdown of the commercial hub of Shanghai, is likely to further entangle supply chains, hampering capital spending. Goldman Sachs trimmed its second quarter GDP growth estimates by 0.1 of a percentage point to a 2.4% rate on Wednesday's data. Some economists, however, do not believe business spending and manufacturing, which accounts for 12% of the U.S. economy, are slowing, attributing last month's modest gain in core capital goods orders to snarled supply chains. Well, we'll see. Quote, not only do manufacturers have plenty of unfilled orders to keep factories running at full tilt, even in the event of a slowdown in demand, we also expect sky-high labor costs and limited availability of workers to motivate businesses to seek labor-saving technologies and support demand for equipment, end quote, said Shannon Seary, an economist at Wells Fargo. Orders for durable goods, items ranging from toasters to aircraft that are meant to last 3 or more years, rose 0.4% after increasing 0.6% in March. They were support. They were supported by a 0.6% rebound in orders for transportation equipment, which followed a 0.3% decline in March. Motor vehicle orders slipped 0.2% after surging 4.8% in March. Orders for the volatile civilian aircraft category rose 4.3%. Shipments of durable goods edged up 0.1% last month after accelerating 1.4% in March. Unfilled durable goods orders rose 0.5%, matching March's gain. All right. So kind of a mixed message there. Some things, are more expensive. Some things are, flattening out. Some people think it's just a supply chain issue. Others think it's just, things are more expensive. All right. Last article here. It's an opinion article about the Fed. The Fed must boost rates by a full percentage point at every meeting to bring down inflation and avoid a job-killing recession. It's written by Peter Maurice, I think Maurici or Moriki. I'm not sure. Don't know the guy. All right. The Fed has taken aim, but it isn't moving fast enough. Earlier this month, the Fed boosted the federal funds rate by 0.5 point, and more half and quarter point increases are almost certain over the remainder of the year. In June, it will start running down as nearly $5 trillion in Treasury, mortgage-backed, and other securities that it purchased by printing money to finance the pandemic relief. Chickens are coming home to roost at this point. Fed Chair Jerome Powell dallied as labor markets overheated and told us all the money he was printing didn't matter. I remember they said it was transitory. Yeah, that's what they said. Now he believes he can bring down inflation without inflicting too much unemployment. Right. Too much money is chasing too few goods. That's basically what inflation is. Households and nonprofits have about $3 trillion more in their checking accounts than before the pandemic. To mop up that and other excess liquidity on business and other balance sheets would take perhaps 4 years at the pace that at the pace the Fed expects to sell Treasury and mortgage-backed securities. We face the danger that Powell will bend to White House pressure to help reelect President Joe Biden, as Chairman Arthur Burns did for President Nixon, and ultimately unleash double-digit inflation. Recent policy missteps aside, structural problems will make the coming decade much tougher in both the United States and Europe than the historic period of mild inflationary pressure of the pre-pandemic years. The U.S. and broader NATO strategy of trying to not antagonize President Vladimir Putin into a nuclear or chemical escalation of the war in Ukraine, including not providing Kiev with jet fighters to provide air cover and weapons to strike military and infrastructure targets in Russia, likely means a stalemate. Russia and Ukrainian exports of agricultural commodities, fertilizer, oil, and gas and metals will be significantly impaired for years. Other sources of supply can be developed, but those will take several years and be more costly. Farmers face higher diesel and fertilizer costs. Food inflation will persist, and shortages of other critical materials, for example, nickel, to help in the transition to green energy, will be exacerbated. Accelerating the shift to green power and electric vehicles is creating shortages of lithium and other metals necessary to build batteries, motors, and transmission lines. It can take up to 10 years to permit and build new mines. Getting high tension lines approved to bring electricity from where the sun shines or hydropower is abundant to where folks need electricity is similarly difficult. Hang on one second. Even before Russia invaded Ukraine, global supply chains were not expected to heal this year, thanks to just-in-time manufacturing and international wage arbitrage. Complex manufacturing systems that stretch to China and elsewhere in Asia are proving inflexible and predisposed to shortages. According to Castle, office occupancy rates remained about half of pre-pandemic levels. Adjustments in the use of commercial buildings, for example, downsizing office footprints and converting those all to alternative uses, and the continued build out of home workspaces will be costly. Even with sales declining, home prices are rising 20% a year because tough zoning and building codes make new construction too expensive within reasonable distances from city centers. Mortgage rates zoomed past 5% in anticipation of Fed tightening, but at the current pace of inflation, mortgages will have to jump closer to 10% to reasonably align demand with supply. China's China's zero COVID policy delayed, but did not avoid slower growth and factory shutdowns. Whereas during our pandemic, it was tougher to get goods made in China to America. Now, with COVID plaguing Shanghai, Chinese plants aren't always making the goods. Biden continued his war on oil and gas by slashing the federal lands eligible for leasing some 80%, jacking royalty charges 50%, and imposing tougher environmental regulations on drillers. Wonder why we have a shortage of oil domestically. It's a mystery. Even the hawks among the Fed officials place the neutral federal funds rate that will neither overheat nor slow the economy at about 2.5%. That's far too low and only about half of what needs to be done. To get inflation to 2%, the Fed should raise the federal funds rate at each meeting approximately every 6 weeks, a full percentage point. I totally agree. I mean, if inflation has been, up over 5, in the 6, 7, 8% range for quite a while now, I mean, the Fed should have done this back in, December, January. You know, waiting until a catastrophe is, looming is the dumbest thing you could ever do. A full percentage point through the sale of Treasury and mortgage-backed securities. It should similarly push up the 10-year Treasury rate to. Oh, that's what it is currently. A recession is becoming increasingly likely, but the longer we wait, the tougher will be the medicine when we face it. And that's true. I've said that more than once. Even even online on my personal pages, it's like you would rather have, you'd rather have things seem good right now, but instead of facing the nasty medicine today. And by doing that, all you're doing is prolonging the problem longer and longer. So again, this is what people wanted, and are there ways to profit from this? Certainly. There are asset classes that are going to do well through this time, whether or not it's a year or it gets drug out for several years. Unfortunately, it's probably not going to be the things that have been the top gainers over the last decade or more. Typically growth stocks and things like that, which do very, very well with little to or very, very low interest rates. So, all right. Well, that's everything I had for today. Hope everyone has a fantastic evening. I'll be back tomorrow. And if anybody needs anything from me, please go to dsafinancialgroup.com. All my information is there. And hope you have a great night. Bye-bye.